Welcome to the Growth Room. Today we're exploring one of the best beginner-friendly investing books ever written, Learn to Earn by Peter Lynch and John Rothchild. In this audiobook summary, you'll discover how businesses create wealth, how the stock market really works, and how ordinary people can build financial knowledge that lasts a lifetime. To kick things off, let's talk about the masterminds behind this guide. If you have ever dipped your toes into the world of investing, you have likely heard of Peter Lynch. He is one of the most successful mutual fund managers in financial history. During his time running the Fidelity Magellan Fund, he achieved an astonishing average annual return of nearly 30%. That means if you had invested $10,000 with him when he started, it would have grown to over $280,000 by the time he retired 13 years later. Yet, despite his legendary status on Wall Street, Lynch's core philosophy is incredibly grounded. He firmly believes that everyday people possess the ultimate advantage over institutional investors if they simply look around them and invest in what they already know. To help bring this philosophy to life, he teamed up with John Rothchild, a gifted financial writer known for turning complex, intimidating economic concepts into highly engaging, crystal-clear prose. Together, they wrote this book because they noticed a massive flaw in the way our society educates people. We spend decades in school learning geometry, geography, and world history, yet almost no one teaches us how to manage our earnings, how a corporation actually functions, or how the stock market can be used as a vehicle for personal freedom. This book bridges that gap, making it a foundational masterpiece for anyone looking to build wealth from scratch. To understand why this book is so unique, it helps to see how it fits alongside other financial classics. For instance, Robert Kiyosaki's Rich Dad, Poor Dad is fantastic for shifting your mindset and helping you understand the difference between an asset and a liability, but it does not dive deeply into the actual mechanics of the stock market. On the other end of the spectrum, Benjamin Graham's The Intelligent Investor is the ultimate Bible for deep financial analysis, but its dense academic tone can feel like reading a textbook. Morgan Housel's The Psychology of Money focuses beautifully on human behavior and our emotional flaws regarding wealth. Learn to Earn stands out because it takes a beautifully holistic approach. It starts from the absolute ground floor, teaching you the history of capitalism and business so that you can genuinely understand what a company is before you ever attempt to buy a single share of its stock. It is the ultimate bridge between economic history and practical, everyday investing. Let us dive into the very first major section of our journey, the history of business. To truly appreciate the stock market today, we have to look back at how commerce evolved. Long before there were skyscrapers, digital stock tickers, or high-speed fiber optic trading networks, there was the barter system. If you were a farmer who grew wheat and you needed a new pair of leather boots, you had to find a shoemaker who happened to be looking for wheat. This was known as the coincidence of wants, and as you can imagine, it was incredibly inefficient. Human progress took a massive leap forward when societies invented money, a universal token that everyone agreed had value. Money meant you could sell your wheat to anyone, pocket the coins, and spend them whenever and wherever you pleased. With a reliable currency in place, the stage was set for entrepreneurship and innovation to change the world. For centuries, most businesses were tiny, family-run operations, local blacksmiths, weavers, and bakers. But as the world expanded and trade routes opened up across oceans, a massive problem emerged. Building a giant wooden ship to sail across the globe to trade spices and silk was extraordinarily expensive and highly risky. If the ship sank in a storm, a single merchant could be instantly ruined. This perilous reality gave birth to one of the greatest inventions in human history, the joint stock company. By pooling money from hundreds of different individuals, the risk was shared and the potential rewards were distributed. This was the foundational spark of modern capitalism. This economic engine kicked into overdrive during the Industrial Revolution. Suddenly, production shifted from small, handcrafted workshops to massive factories powered by steam and machinery. This era proved that when individuals are free to innovate, compete, and risk their own capital to create better products, society as a whole advances. Think about how entrepreneurship works today. A visionary recognizes a problem, takes a financial risk to build a solution, and if successful, changes the daily lives of millions. Think of how companies like Coca-Cola or Costco grew from simple ideas into global empires by mastering this exact process. Innovation is not just about inventing a completely new technology. It is about finding a way to deliver value to people more efficiently than anyone else. Capitalism, at its core, is a system fueled by human ingenuity and the desire to build something meaningful that the marketplace values. Understanding this history is crucial because when you invest in a stock today, you're not just buying a flashing ticker symbol on a phone screen. You're participating in this exact same historical tradition of human enterprise. Moving forward into part 2, let's unlock exactly how the modern stock market operates. To the uninitiated, the financial market looks like a chaotic casino filled with flashing red and green numbers, complex jargon, and talking heads shouting predictions on television. But once you strip away the noise, the core concept is beautifully simple. What exactly is a stock? When you buy a stock, you are purchasing a tiny piece of an actual business. It is a certificate of ownership. If a company has 1 million total shares outstanding, and you buy just one share, you officially own 1/1,000,000th of that entire enterprise. This means you are a shareholder. You are a part owner of the building, the inventory, the brand name, and most importantly, a piece of all the future profits that business generates. Why do companies sell these shares in the first place? Imagine you start a local tech company or a brilliant new retail store, and it becomes wildly successful. You want to expand across the entire country, but building new warehouses, hiring thousands of workers, and buying advanced equipment requires millions of dollars you simply don't have. You have a few options. You could go to a bank and take out a massive loan, but then you're saddled with heavy interest payments that must be paid back every single month, no matter how the business is doing. Alternatively, you can choose to go public. This means you slice your company up into millions of tiny pieces and sell those pieces to the public through an initial public offering or an IPO. Investors give you cash, and in return, they get a slice of ownership. The company uses that fresh cash to fuel massive growth without the crushing weight of bank debt. This brings us to stock exchanges, which are essentially giant digital supermarkets where these slices of ownership are bought and sold every single day. The most famous ones are the New York Stock Exchange and the NASDAQ. Think of it like a global marketplace. If you want to sell your shares of Microsoft or Apple, you don't have to go hunting for a buyer yourself. The exchange matches you instantly with someone on the other side of the world who wants to buy them. Because millions of people are constantly buying and selling on these exchanges, stock prices are subject to continuous market fluctuations. Prices change second by second based on the absolute law of supply and demand. If a company releases an incredible new product, say, NVIDIA launching a revolutionary new artificial intelligence chip, thousands of investors will rush to buy the stock. When there are far more buyers than sellers, the price goes up. Conversely, if a company reports disappointing sales or faces bad publicity, anxious investors will look to sell their shares. When there are far more sellers than buyers, the price goes down. This introduces the classic dynamic of risk versus reward. Historically, stocks have outperformed bonds, savings accounts, and real estate over the long term. But that reward comes with a price: volatility. In the short term, the stock market is highly unpredictable. It reacts emotionally to political events, economic reports, and global news. Lynch compares the stock market to a highly volatile neighbor who offers to buy your house or sell you his at a different price every single day. Some days he is wildly optimistic and quotes a massive price. Other days he is deeply depressed and names a dirt cheap price. The secret to successful investing is recognizing that your neighbor's shifting moods do not change the actual physical structure or intrinsic value of your house. Your job as an investor is to tune out the daily market noise and focus entirely on the underlying health of the businesses you own. Now, let's move into part 3, how businesses make money. To be a great investor, you must first learn to think like a business owner. Every single company on the planet operates on the exact same fundamental mathematical equation. It all starts with revenue, which is also commonly called sales or the top line. This is the total amount of money that flows into a company's cash registers when customers buy their products or services. For example, when millions of people buy an iPhone, a MacBook, or a subscription to iCloud, all of those billions of dollars combined make up Apple's total revenue. But revenue is not what a company actually gets to keep. To keep the lights on, every business faces expenses. They have to pay for raw materials, factory rent, employee salaries, shipping costs, marketing campaigns, and taxes. When you subtract all of these operating expenses from the total revenue, you're left with profit, also known as net income or the bottom line. Profit is the holy grail of business. It is the actual money left over for the owners. If a company brings in $1 billion in revenue, but spends $1.1 billion on expenses, is losing money and heading toward bankruptcy. This is where the brutal reality of competition comes into play. In a free market economy, whenever a company starts making massive profits, other entrepreneurs notice. They immediately try to build a similar product, make it cheaper, or add better features to steal those profits away. This is why a company's business model is so incredibly vital. A business model is simply the strategy a company uses to generate revenue and sustain profitability over time. Look at Costco, for instance. Their business model isn't centered on making huge profits by marking up the price of hot dogs or cereal. Instead, they sell items almost at cost to keep customers incredibly happy, and they make the vast majority of their profit from annual membership fees. It's a genius model because it creates highly predictable, recurring revenue year after year. To survive and thrive against competitors, a business must achieve sustainable growth. Growth can happen in a few ways. A company can find new customers, open up stores in new countries, invent completely new product lines, or find clever ways to cut their expenses and become more efficient. As an investor, your ultimate goal is to find companies that possess a durable competitive advantage, something that acts like a protective moat around a castle, keeping rivals at bay while the business continues to grow its profits for decades to come. Let us venture into Part 4, Investing Fundamentals. This is where the rubber meets the road, turning abstract financial concepts into a practical machine for personal freedom. Peter Lynch emphasizes that the single greatest weapon an ordinary investor possesses is not a fancy Wall Street degree, access to high-speed trading algorithms, or inside information. Your ultimate weapon is time, paired with absolute patience. To illustrate this, let us look at the mathematical miracle of compound growth. When you invest in the stock market for the long term, your money does not just grow linearly, it grows exponentially. Think of it like rolling a tiny snowball down a snow-covered mountain. At first, the snowball gathers just a few flakes. It looks small and insignificant, but as it continues to roll, the snow sticks to the snow that already stuck to it. By the time it reaches the bottom of the mountain, it is transformed into a massive, unstoppable avalanche. In the financial world, compounding works the exact same way. When your investments earn a return, that profit is added to your original principal. The next year, you earn interest not just on your initial money, but also on the interest you earned the year before. Over 5 or 10 years, the results look pleasant but modest. But over 20, 30, or 40 years, the compounding effect becomes mind-blowing. This is why financial literacy is one of the most life-changing skills you can ever master. It completely reframes how you look at every dollar you spend. You stop seeing a $10 gourmet coffee as just a $10 bill. You start seeing it as $50 or $100 of future wealth that you just sign away. One of the primary fuels that accelerates this compounding engine is dividends. Dividends are essentially a direct cash reward that a stable, profitable company sends to its shareholders, usually 4 times a year. When a company like Coca-Cola or Microsoft brings in billions of dollars in profit, they do not always need to reinvest every single penny back into building new factories. Instead, they take a generous portion of those excess profits and deposit them directly into your brokerage account as cash. As a beginner, the smartest move you can make is to set up an automatic dividend reinvestment plan, often called a DRIP. Instead of spending that cash, Your account automatically uses those dividends to buy even more fractional shares of the company. This creates a beautiful, self-sustaining loop. More shares generate more dividends, which buy even more shares, supercharging your long-term wealth creation. However, to survive the journey long enough to experience the magic of compounding, you must protect yourself using diversification. Diversification is the financial equivalent of the old age wisdom. Don't put all your eggs in one basket. Imagine you take all of your life savings and invest it entirely into a single, trendy tech startup. If that company gets disrupted by a competitor, suffers a massive cyber attack, or goes bankrupt, your entire financial future is wiped out in an instant. By spreading your money across 20, 30, or even hundreds of different companies across various sectors, such as healthcare, technology, consumer goods, and energy, you insulate yourself from catastrophe. If one company struggles, the steady growth of the other businesses shields your portfolio from total ruin. The final, and perhaps most difficult, pillar of investing fundamentals is avoiding emotional investing. The stock market is a mirror that reflects human psychology, specifically the constant pendulum swing between wild greed and paralyzing fear. When the market is booming and everyone on social media is bragging about making quick profits, greed drives people to buy overvalued assets at the absolute worst time. Conversely, when the economy hits a rough patch and stock prices drop, fear takes over, causing people to panic sell their high-quality investments at a massive loss. Lynch reminds us that your stomach is far more important than your brain when it comes to investing. Anyone can have the intellectual capacity to understand a balance sheet, but very few people have the emotional fortitude to watch their portfolio drop 20% during a market correction and calmly do absolutely nothing. Or better yet, view it as a Black Friday clearance sale to buy more great companies at a heavy discount. Long-term investing is a test of character, discipline, and unwavering patience. Now, let us move into part 5, how to analyze a company. Once you commit to becoming a long-term investor, how do you actually separate the winners from the losers? You do not need to be a math genius, but you do need to look at a few beginner-friendly fundamental health indicators. First, you look at sales growth. Is the company pulling in more revenue this year than it did last year and the year before that? Consistent sales growth proves that the company's products are still highly in demand and that the business is actively expanding its footprint in the marketplace. Second, you examine the earnings, which is just another word for net profit. A company can have flashy advertising and massive sales, but if its earnings are consistently negative, it is a money-burning machine. You want to see a steady, predictable track record of rising earnings over time, because over the long haul, a stock price will always follow the direction of its earnings. Third, you must check the company's debt. Just like a household, a business that is drowning in debt is in a highly fragile position. If the economy slows down and sales dip, a company with zero debt can easily weather the storm, cut expenses, and survive. But a company burdened with massive interest payments to Wall Street banks can easily be pushed into bankruptcy. Look for businesses with low debt and plenty of cash flow, the cold, hard cash left over after all bills are paid, which gives the company the flexibility to innovate, buy back shares, or survive economic downturns. Finally, you evaluate qualitative factors like competitive advantage and management quality. Does the company possess a moat like Amazon's massive logistics network or Apple's fiercely loyal ecosystem? And is the company run by honest, capable leaders who act like owners, or executives who are only interested in lining their own pockets? Assessing these traits transforms you from a gambler into a true investor. Moving forward into part 6, let's confront the psychological minefield of the market by breaking down common investing mistakes. Peter Lynch has seen it all, and he emphasizes that most people lose money in the stock market not because the market is rigged, but because they fall victim to predictable behavioral traps. The first classic mistake is following hype. We see this play out constantly in modern cycles. Someone hears a rumor at a dinner party, watches a viral clip on social media, or reads an enthusiastic post online about a can't-miss opportunity. Suddenly, FOMO, the fear of missing out, takes over. Investors rush to pour their hard-earned savings into a business they don't understand, buying at the absolute peak of the frenzy. Whether it is historical speculative bubbles, modern cryptocurrency hype, or volatile meme stocks driven entirely by internet momentum, the result is almost always the same. When you buy an asset purely because its price has been going up, rather than because the underlying business is actually healthy and making money, you aren't investing. You are gambling, and you are waiting for a greater fool to buy it from you at a higher price. When the hype inevitably fades, the floor drops out, leaving latecomers holding the bag. This links directly to the second major mistake: chasing quick profits. The modern world loves speed, and financial media constantly bombards us with stories of overnight millionaires. This creates a dangerous illusion that the stock market is a get-rich-quick scheme. In reality, real investing is a get-rich-slow process. When you try to time the market, trying to buy at the exact lowest point and sell at the exact highest point, you're playing a losing game. Study after study shows that even professional traders fail to time the market consistently. By constantly jumping in and out of stocks, trying to capture short-term pops, you rack up heavy transaction fees, trigger massive tax liabilities, and usually miss out on the biggest upward moving days of the market. Then comes the most destructive trap of all: panic selling. When a stock market experiences a natural correction or a temporary economic downturn, stock prices tumble across the board. High-quality, incredibly profitable companies get dragged down right alongside the bad ones. This is when panic sets in. An investor logs into their brokerage account, sees a sea of red numbers, and allows fear to override logic. To stop the emotional pain of watching their balance drop, they sell everything, locking in their losses. Lynch points out the sheer irony of this behavior. When your local grocery store or favorite clothing brand puts their best inventory on a 50% off clearance sale, you rush inside to buy as much as you can. But when the stock market goes on a massive clearance sale, people run out the door screaming. Panic selling happens because of a fundamental lack of research. If you don't know exactly why you bought a stock in the first place, you won't have the courage to hold on to it when the price drops. Now let's transition into part 7, building long-term wealth. How do we synthesize all of these lessons to create a bulletproof wealth-building machine? It begins by fundamentally shifting your mindset and learning to think like an owner. When you buy a share of a company, you aren't just trading a digital token. You are becoming a business partner with the brightest minds in corporate history. When software developers write code at Microsoft, when logistics experts optimize warehouses at Amazon, or when designers create the next generation of technology at Apple, they're working to make you richer as a shareholder. To capitalize on this, you must build the habit of investing consistently. This is accomplished through a powerful strategy known as dollar-cost averaging. Instead of saving up a massive lump sum and waiting for the perfect moment to invest, you commit to investing a fixed amount of money, say $100, every single month completely on autopilot. When the market is high, your $100 buys fewer shares. When the market crashes, your $100 automatically buys more shares at a discount. This completely removes emotion from the equation and ensures you are constantly building your position over time. This strategy requires a profound level of financial discipline. It means choosing to live below your means today so that you can buy back your freedom tomorrow. Wealth is not the flashy car parked in the driveway or the expensive designer clothes on your back. Wealth is the unseen assets, the stocks, bonds, and investments. They're quietly compounding in the background, working for you while you sleep. True financial freedom is reached when the passive income and growth generated by your investments completely covers your daily living expenses. At that point, working becomes a choice rather than a mandatory survival chore. To achieve this state of freedom, you must embrace the learn-to-earn framework in its entirety. Learn continuously, understand the actual businesses behind the ticker symbols, invest for the absolute long term. Diversify your portfolio widely to mitigate catastrophic risks, maintain strict discipline, and deliberately ignore the endless stream of short-term market noise. Let us bring this entire journey together into a cohesive blueprint for your financial future. Peter Lynch and John Rothchild's timeless classic teaches us that building wealth isn't a secret club reserved for Wall Street elites. It is an open game accessible to anyone willing to learn the rules, practice patience, and think like a business owner. Before we look at your practical action plan, let us cement the core principles we have uncovered. A stock is a real business. Never look at a stock as a mere gambling token. It is a tangible slice of ownership in a real enterprise with real employees, real products, and real profits. The power of compounding. Your greatest financial asset is time. By consistently reinvesting dividends and letting your returns compound exponentially, modest savings transform into life-changing wealth over decades. The moat analysis. Successful investing requires looking under the hood. Check for rising sales, healthy earnings, low debt, and a durable competitive advantage that keeps rivals at bay. Emotional fortitude over IQ. The market is a pendulum swinging wildly between greed and fear. Master your emotions, expect natural market downturns, and treat market crashes as rare clearance sales rather than reasons to panic. Your practical investing action plan. You do not need thousands of dollars to begin. You can start building your financial fortress today by taking 3 highly practical steps. 1. Build a safety buffer first. Before pouring money into the stock market, ensure you have an emergency fund covering 3 to 6 months of living expenses tucked safely away in a high-yield savings account. This acts as your financial shield, ensuring you never find yourself forced to panic sell your long-term stocks to pay for an unexpected car repair or medical bill. 2. Automate your investing. Set up an automatic transfer from every single paycheck directly into your brokerage account. Whether it is $50 or $500, practice dollar cost averaging by automatically buying broad market exchange traded funds, ETFs, or a diversified basket of high-quality companies. By automating the process, you remove emotional decision-making entirely. 3. Commit to lifelong learning. Treat financial literacy as a continuous journey. Pay attention to the world around you. When you see a company like Costco packed with loyal customers every weekend, or realize everyone around you relies heavily on Microsoft software, let it spark your curiosity. Read their financial reports, look at their debt, understand their business model, and invest in what you know. An important note on your journey. The principles outlined in Learn to Earn are designed for educational guidance and wealth-building literacy, not guaranteed overnight financial advice. Markets inherently carry risk, which is why long-term thinking and broad diversification are your absolute best friends. Do not chase overnight hypes or get-rich-quick schemes. Invest in human ingenuity, buy stakes in excellent businesses, and let time do the heavy lifting. You have the knowledge, you understand the history, and you possess the ultimate tool for freedom: time. The only thing left to do is take action and start building the future you deserve. Thank you so much for watching and listening to this deep dive into Learn to Earn here in the Growth Room. If you found value in today's summary and feel a little more confident about taking control of your financial future, please hit that like button right now. It immensely helps the channel grow and pushes this financial literacy out to more people who need to hear it. If you want to keep feeding your mind with life-changing concepts, make sure to hit subscribe and turn on the notification bell so you never miss our upcoming audiobook summaries. Now, I want to hear directly from you. Our community thrives on the insights we share with one another, and I read and reply to your comments to help build a true space for lifelong learners. Drop a thought below and let me know. What investing lesson from Peter Lynch surprised you the most today? Which financial habit or action step are you going to start implementing this week? What incredible book should we break down and summarize next? Don't keep this knowledge to yourself. Share this video with a friend, a family member, or a colleague who is ready to start their own investing journey. Thank you for your time. Stay disciplined, keep learning, and I will see you in the next video.